So last week's move in GMC was historic as the Wall Street bets crowd pushed Gamestop to near $500 a share. A shift is coming as to the next bet, which appears to be AMC Theaters. In this video, I want to quickly recap what happened last week with our GMC strategies and move on to AMC, looking at price projections, but more importantly, the option prices or implied volatilities, and what I believe are the best strategies for AMC. So let's go. Hey everyone, Tom Gentile. Welcome to Tom's Trading Room, where we attempt to teach you how to spot opportunities and create alternative risk trades than simply buying and holding the stock. So AMC is the new buy on the block, or is this just a one-time thing that happened last week? We're going to get into both of these stocks, so let's do that right now. Okay, quick recap on Gamestop. As you can see, last week, actually the beginning of last week, this is when the stock was trading below 100. And of course, we went as high on Thursday as near $500 a share before pulling back and closing around $325. Now, this stock, again, is all over the place, down today as of this recording. But I want to talk about last week. I want to talk about the strategies and what ultimately happened. So last week, we discussed a couple of different things. If you were bullish, bearish, or neutral on GameStop and you wanted to have some sort of a position that had limited risk, that was not all over the place, like buying the stock if you were bullish or shorting it if you were bearish. And so we talked about sell the options premium. And by doing it safely, we discussed bullish put spreads, bearish call spreads, and even putting on iron butterflies. I'm not going to go into those strategies with you right now. If you want to see that in detail, check out last week's video. What I want to talk about is the results from these three. And so it's a toss-up. If you were bullish on GME and you chose the GME bull put spread, and what I'm talking about is just simply selling out of the money puts and buying further out of the money puts for protection, those expired worthless. Now you might think, well, that means I lost money. No, if you sell something that ends up being worthless, you keep what you sold. So the bull put spreads did well. The bear call spreads, however, what ended up happening with those is that as GME moved up, these both became in the money, the buy side and the sell side. So the short strikes were assigned to becoming short stock. The long strikes were exercised, becoming long stock, offsetting each other. So a maximum loss occurred. The iron condor, if you were able to put both of these on, you could have had a very small loss and maybe even nothing, depending on what fills could have been had. So when you add all of these up together, it was really a wash. One side made money, the other side lost money. And so the thing is that, well, how do you make money in this if one side's going to win and one side's going to lose? Well, number one, depends on what side you were on. If you were bullish last week, you made money. If you were bearish last week, you lost money. And if you did the iron condor, you probably end up at a wash, meaning half the trade made money and half the trade lost money. All right, let's move forward. So small plug for tomsoptiontools.com, because on the left-hand side, I have all of the options right now that are expensive using what we call IV percentiles. We go back in the entire year, and we see where has that stock's options been at its cheapest during the year, most expensive during the year, and right now. And so these are the top 10 that are showing us extreme volatility in the options right now. So I'm going to get back to these in just a moment. I also pulled up in Robinhood last week, amongst many messages I got, was the messages on the stocks which they were putting extreme measures in. So, for instance, with AMC, you could only buy 10 shares of stock on AMC or trade 10 option contracts. And of course, BlackBerry, Express, GME, Genus, Cost, Naked, and Nokia. The NAs over here meant that Cost and NAKD, they don't have options contracts. So if you look at the 2, 4, 6 of the 6 that have option contracts, look over here to the left, and you'll see AMC is in this area. BB, BlackBerry is in here too. All right, here's Express. And here is GME. So their top 4 are in my top 10 in terms of finding those expensive optionable stocks. SLV is in here as well because it's been getting a lot of fanfare from the social media group Reddit. Other than that, there are some stocks on here like Gamestop that can be tilted for the short term. So let's look ahead to AMC. And so if you take a look at AMC, we'll look at projections and strategies. This is a 30-day price chart on AMC, and this is as of Friday afternoon, so it does not include today's price in it. But as of right now, AMC popped to go as high as over $17, came back down to 13.5, and looks like it's trying to fill that close on Friday. So we'll see where we go from here. But right now, AMC looks like it is the volatile one on the block as far as today, and also the one of only a few that are actually up on the day in terms of the Wall Street Bets watch list. All right, back to the chart. Here's what you won't find everywhere. And again, this is at tomsoptiontools.com. We look at implied volatility charts on the options. Now, back over here at the end of the year, this was already expensive. I mean, you look at the VIX, which is trading in the teens right now, and you see something that's 100, let's call it 150. This already had 10 times the implied volatility, the option premium levels that the overall VIX had. But look at where we went out on Friday. This is the 7-day options. The 7-day options were trading north of 600, 627 to be exact. But then if you take a look at the moving averages on the implied volatilities are also moving higher. Here's the other thing, what you don't see. The longer-term options are also moving higher, suggesting that volatility is going to remain in AMC theaters for the time being. Now, let's take a look at the actual option prices themselves. These are the put options. I'm only going to do one of the strategies that we talked about last week just to save time. And once again, if you want to look at all of the option selling strategies we were looking at, not just put selling strategies, take a look at last week's video because we talk about the bearish side and the neutral side. But if you take a look, Friday going out, you can see that the 13 puts, which were very close to being at the money, were trading $4.78 in the middle, had an implied volatility of over 700. So that's incredible. And then when you look down, the implied volatilities were similar. But I mean, even the 7 put with, this is 1 week to expiration. These options expire this Friday, February 5th, had a 95-cent price tag on it. That is huge. What that means is that option traders actually believe that this week AMC could drop down as low as near $6, $6.05 based on that timestamp that happened Friday afternoon. Now, we're double that right now. We're trading at 14. So are the option traders saying there's a chance that AMC could get cut in half? Absolutely. And they're pricing these options in accordingly. Now, one of the ways, if you really think that AMC is going to be at or above the strikes that you see here, one of the things we could do is what's called a put spread. And now, instead of selling puts, by the way, if we were to sell the 13 put, we'd take in $4.78, but we'd have over $9 of risk to zero. If you want something that's a little bit cheaper and that maybe your broker might take, because a lot of brokers have cut off put selling for literally everyone in the retail side for the time being for stocks like AMC. But I checked, and you can do put spreads on this particular stock, at least with Charles Schwab and the TD Ameritrade platforms. So what is a put credit spread? Well, that's when you sell a higher strike put and you buy a lower strike put for protection. All right, it's bullish, and the net credit is net result is a credit to your account. So from there, what I did was I was looking at the 13 and the 8, selling the 13 puts, but then buying the 8 puts for protection and taking in. Now, Friday, this was being done for $3.40. Something happened between Friday and Monday. I'll talk about that in just a moment. But if we were to get this trade, all right, on Friday last week and get filled at the 340 level, basically what that means is that you have a position where if you are, and let me get the break evens for you, $9.60, if we're at $9.60 or higher by this Friday, February 5th, this trade actually is profitable. If we're below the $9.60 area, then the trade is in a losing situation. The maximum loss that this trade could occur would be below the $8 strike price, right? And how much risk does it have on it? Well, it looks like it's less than $200. Let's go back and look at our graphs. And we can see that the maximum profit was $3.40. The maximum risk was $1.60. All right, I like trades that make more money than they lose. And here's the best part. Even if AMC stays where it is, all right, even if it's above the $13 mark, this still maxes out. This has a maximum profit potential at where the trade is right now. So there is a higher probability that the trade is going to be above this break even by expiration. But it's not as high as you might seem. A lot of option traders think that if you put trades on that are out of the money, they have an extremely high probability. But because the stock has moved around so much in so few of days, it is knocking the probabilities down. They are still quite good. You look at the last 6 days. Statistical volatility. All right, so AMC Theaters has moved over 1,100%, 1,100% just in the last 6 days in terms of statistical volatility. That's why the option prices are so expensive, because traders have no idea where this is going to go from one point to the next. 7 days, 5 days, 3 days. Now, on Friday, February 5th, all things considered, just looking at statistics, the trade that I showed you has a 60% chance of having a probability of profit, right? And so keep that in mind when we look at this. That still there's almost a 40% chance that the trade could lose money. Why is that? Because the stock is moving around a lot. But if we look at the talking points, and again, let me mention, I'll mention this, is that with our talking points, this is just the bullish scenario. If you're bearish on AMC Theaters, then call spreads might make the most sense, at-the-money call spreads, all right? And there are neutral strategies too. Prices can bounce around fast. I said this last week. I like to use limit orders to get my price. And while nothing is a guarantee, credit spreads do have a higher probability of profit to risk than anything that I've seen this week, especially in the Reddit Wall Street Bets community. Before I close this video, I have to say that this environment feels a lot like 1999 again. Remember that era when everyone was buying anything that was a .com back then? That came to a close within months. Or perhaps you can't think that far back. What about the last 10 years or so? Remember when fast money made its debut and everything that Cramer said went up 10% or more the following morning? Again, that lasted a few months before fizzling out. The difference between then and now is we didn't have millions of people on a discussion forum being told what stock was the focus of attention. But humans are creatures of habit, and eventually this group will fail as many will disband and try to get their own stocks pushed. It's not my wish for them to fail. It's just an inevitable pattern. And once again, folks, what do we do here? We attempt to spot patterns and create alternative risks from those patterns than simply buying and holding stocks. All right, hope you enjoyed the video. We'll see you on the next one. Bye now.